right, thank you, Joseph Utsen, for the background report. And joining us now is Dr. Mohammed Tumala, Director, Monetary Policy Department of the Central Bank of Nigeria. It's a pleasure to have you join us.
Thank you very much, guys. Thank you.
All right, we also have here with us Professor Uche Waleke, President, Association of Capital Market Academics of Nigeria. Thank you for joining us, as always.
Thanks, Victor.
You know, Mr. Uche has plenty caps. Thank you for joining us. Yes, Nassarawa State University, and essay to the Chairman Committee of Finance, National Assembly. So thank you so much, the regular. Thank you so much. And we also have another regular here in the studio, Ni Akinsiju, Investment and Financial Analyst. He's also the Chairman, Independent Media and Policy Initiative and Investment, and also Financial Analyst. Welcome to Good Morning Nigeria, as always.
All right. Let's begin with Dr. Tumala. A lot of figures. Juma was saying earlier that she's not quite making a sense of all the figures.
Yeah.
So that's why we have you here. So break it down for us. What are these figures all about? What are the decisions that have been arrived at? And what are the implications?
Well, the figures rolled out. One was NPR, increased.
And NPR is what? Because
monetary policy rate is a base rate for the market, and it moved to 22.75. In the language of monetary policy, that is further tightening. And tightening to the man on the street means less credit in the economy, and also more of savings back into the banking system. The second component of the numbers is the CRR. The CRR.
The CRR. You have to define those terms.
Cash reserve ratio.
Okay.
It is that portion of deposits, cash deposits with the banks that the central bank holds, and this is not available for banks to create credit. And you remember I said raising NPR is a signal that we are tightening. The bank is tightening. We want a tight monetary policy stance. It is not expansionary, and therefore banks will have to create, larger reserves with the Central Bank of Nigeria. So it just signals what amount of money, what proportion of money is available to commercial banks to lend to their customers. That's what it means. The other number is the asymmetric corridor. That corridor gives us a guidance on the behavior of money markets. So you have two limits. Okay, the lower limit, is indicates the rate at which central bank can lend to banks, or banks can borrow from the central bank. So the reference point is the NPR. So it comes down 7% or 700 basis points from the NPR. And of course, the upper limit is the limit beyond which we think banks should be able to trade between themselves. So that corridor is a corridor within which we think the money market, the overnight rate should actually oscillate in. If it is outside of that corridor, the bank looks at the factors that are driving that, like high liquidity, very high liquidity, or very low liquidity or negative liquidity situation, the situation is very tight, you will see the OBB moving above, that corridor. Yes. So it's a guidance for central bank.
So the decision, sort of sent some shockwaves across the financial sector. And I was reading of a lot of comments from experts in the financial sector, and the question they are asking is, will this decision moderate inflationary pressure on the economy as it is now?
Well, the decision is targeted at moderating inflation, but the decision also anchored market expectation. So market, of course, expected the central bank to tighten further because the real rates is large and negative. Okay, so that's the expectation of the market. Of course, market will not say that the decision was not in the right direction. But of course, there is a lag of time, when you begin to see the effect of that decision.
All right, let me get to Professor Waleke. Well, the director has said quite a number of things, and but at the end of the day, he said it is to moderate inflation.
Yes.
Do you see a pathway to moderating inflation in all of this?
Of course I do. I do, Victor, and I also want to agree with him that there was the need to tighten, further tighten monetary policy. If you look at where inflation rate is, today, at 29.9%, food inflation well over, 35%. So the way to actually contain inflationary pressure is actually to tighten, to tighten monetary policy. And one of the tools at the disposal of the central bank to tighten monetary policy is the monetary policy rate. There are other tools, but also available to the central bank. So the expectation was that monetary policy was going to be tightened by markets, just as rightly observed. But the thing there is, if we agree to tighten, okay, how do we tighten? And by how much do we tighten? So that's where I differ. Okay, I had expected the tightening to be approached in a measured and an incremental manner, in a manner that would not appear to be, distortionary. In my view, I think the increase that we saw was rather steep. All right, you have an unprecedented 400 basis point increase, such that today the rate has moved from 18.75% to 22.75%. So I think it was too steep. I had expected something not more than 200 basis points, at least, given the fact that MPC is also meeting next month, March. So if you increase by 200 basis points and you don't think you're satisfied, you can also do another, increase. So I had expected incremental, measured, as opposed to the way it was done. And part of why too I thought the increase was too sharp. The MPC didn't just stop at the monetary policy rate, increasing it. Okay, remember, you just had that the monetary policy rate is actually the rate at which the central bank lends to the commercial banks. The corridor +1 -7. +1 is actually, just as he tried to explain, is the effective standing lending rate. In other words, by the time the central bank is lending, central bank is actually lending to them at 22.7 +1, 20.75 +1. Okay, and when they now deposit their free funds, more or less, with the bank, the central bank remunerates them, at -7. So the point I'm making is, it's apart from increasing the monetary policy rate, okay, the central bank, the MPC, also jacked up the cash reserve requirements. The requirement of 32.5% previously was now jacked up to 45%. So when you look at these two, I think the effect was it came to, for me, it was a big bang, all right, and that's why I feel the shock absorbers we have in the economy, would it be able to absorb that without really hurting growth? Okay, so it has, he also mentioned it, and it has an implication, for credit, access to credit, because monetary policy works through several channels. You have the interest rate channel. Right now, interest environment is going to be very high. Okay, you have the credit channel, so it's going to affect the access to credit. Okay, small businesses we're not finding it more difficult to access credit because the interest rate has gone up. Okay, and people say that the banking sector credit to the real sector is usually small, so it may not be significant, but that's not the case, because even in the informal sector, credits that are given in the informal sector also have an eye on the on the NPR and on the general interest rate environment. If you come to borrow from me, for example, now, because of the interest rate environment, I'm likely going to ask you for a higher interest rate. So even in the informal sector, we should expect that to happen. So another likely impact of this is that it's also likely to affect the asset quality of banks. When we talk about asset quality of banks, one of the yardsticks or indicators of asset quality is banks' non-performing loans. Okay, so you should expect now that banks will start writing their customers, repricing their loans, saying your interest has now been increased on the basis of the fact that NPR has been jacked up by as much as 400 basis points. So when the bank writes you and tells you your interest on the loan you took has been increased, okay, you are likely to default. So default risk now has been raised. Okay, that's one of the implications. And another thing I also say is even the cost of servicing government debt, will also increase. So it's also going to affect even what we have provided for the 2024 budget. Yes, of course, domestic debt. So, well, generally, I want to say that I'm in alignment with the idea of further tightening monetary policy, because the central bank, of course, that is their primary responsibility to maintain monetary and price stability, to also worry about inflation. Okay, but where I differ is how you go about it. Okay, if you're tightening monetary policy, okay, you should also have an eye. You're doing that with an eye on the consequential outcomes. On exactly.
If you say that you're trying to manage inflation, trying to food inflation, particularly like you had mentioned, when small businesses cannot access loans because the interest has gone up, it's like taking from one end and giving from one end and taking from the other.
Absolutely, that's what I was saying. You see, the adverse effect of the action on output is some people have argued that central bank has this inflation targeting objective. Now they say they want to target inflation, and for good reason. Yes, inflation is a problem. We need to wrestle inflation, but again, when you look at the factors driving inflation in Nigeria, they are not entirely monetary factors. They are not entirely factors that the central bank, has control over. Okay, if it is the issue, even in the communique, if you check the central bank, the MPC communique that they released, in that communique they mentioned 4 factors driving inflation. One of the factors is security challenges in the food producing areas. That one is not within the purview of the central bank. Another factor mentioned there is high fiscal deficits on the part of government, spending. It's not within the control of the central bank. Okay. Then you also have rising energy costs. Rising energy costs, whether it's the cost of pump price of fuel, electricity, these ones are not within the purview of the central bank. The fourth factor they mentioned, which is the one that they can control, is exchange rate pass-through. All right. Now, on that score, I want to also commend the bank, central bank, for what they have done, so far in the area of trying to bring down exchange rates. They have taken a number of policies, whether it's beginning with removing the limits on margins for IMTOs, enforcing net open positions, even clearing the genuine backlogs. Okay, and the recent one they have done, with respect to guidelines, the drafts for BDCs, those are measures in the right direction, to ensure that the naira, international value of the naira is restored. Okay, so but on the other factors and the other first 3 factors, it is not the central bank that will tackle it. So when you consider the supply side factors affecting inflation, okay, that tells you therefore that the fight against inflation is not just the central bank. So the central bank cannot begin to say that it can use just the monetary policy rate by raising it to even if they raise it to by 1,000 basis points, okay, it may not really crash inflation because of these other factors driving inflation. All that they will end up doing is to now distort these other economic activities. So it's important that in an economy that is struggling to grow, we don't take actions that will hurt output, even though you can argue it's not part of the central bank's mandate. But again, it's something important to consider.
Indeed, something important. So let's bring in Ni Akinsuju now, and you analyze investment on the financial sector. Did it come to you as a surprise that the decision taken by the CBN to implement all these policies they were really out in their the decisions they make, and how will it affect Nigerians? Because it's all about Nigerians. These policies cannot be implemented with nobody. It's all about Nigerians. And like I said earlier, I read a lot of write-ups, especially Muda Yusuf's write-up yesterday, and he seemed not to agree, completely with the decision of the central bank. Let's have your views on that. And how do you think, if the central bank could take advice from financial analysts like you, how do you think it might sort of change the narrative here?
Well, it depends on where you stand in the divide.
Yes.
In this matter, I want to stand by the CBN.
Okay.
One, because I used to be an acolyte of Alan Greenspan, the very, very ancient chairman of the U.S. Reserve. When I listened to the rollout of the MPC decisions, it was deja vu for me. That was like an Alan Greenspan, in the seat. I think what the CBN had done is to apply what we call the epidemic approach. You put a needle into a troubled scenario, and you inject, policy that is supposed to address a drastically challenging situation. We've had near 12 months of consistent increase in prices, in inflation rates. We have also had a situation of near foreign exchange rate crisis. And therefore, what should be the approach? I think the CBN had decided and determined that it would use the tools available to it to address these challenges. And I also think going forward, there will also be a linkage between the monetary policy authorities and the fiscal authorities on how to collaboratively, reduce the tension, in all the factors that have been, that are more or less causing this issue. Now, we need to have a flip back to understand the context of what is happening now. Over the last 8 years or thereabouts, the government had intentionally determined on what to apply the expansionary policy. We've had recessions because of declined revenue. We've had recessions because of COVID and all that. And government was determined to take us out of that recession. To do that, it decided that it had to spend more money. It adapted the Keynesian approach. You spend more money to get us out of this narrow strait, as it were. And in spending money, at the end of it, this is what you get, a surfeit of liquidity. So much money supply in the system. So it becomes an headache too. That was supposed to be a solution at the point in time. The solution had now become the problem. So how do you now also resolve that problem? It is to create that atmosphere or the perception of a perception of intolerance of liquidity. Because for the central banker, when you have so much money in supply, it will drive price. And one of the mandates of the central bank is to stabilize price, And in doing that, it will mean that you will have to affect growth, economic growth. Affecting economic growth means that when you increase the rates, the NPR rate, you are discouraging banks, not even banks, you are discouraging businesses to approach banks for credit. So essentially, you are reducing credit creation. As at December, between October and December 2023, we had perhaps the highest possible credit creation, in the history of credit, money deposit banks in Nigeria, where we have up to about 63 trillion naira credit, worth of credit in the system. That tells you there's a huge, huge liquidity in the system. And the basic economics explanation of inflation, basic, more money, pursuing less supplies, So the basic thing to do is to reduce the money, the money supply. And in doing that, you increase the rate. When you increase the rate, of course, it is not a Muda Yusuf will not be happy because he's an entrepreneur advocate. And an entrepreneur advocate wants entrepreneur at all times to be able to access funds at the cheapest possible rate, But a central banker would want at a point in time, and don't forget, it's a point in time. It's a medication applied to impact a system for effect at the point in time. So the central banker, to my mind, and I think that's our expectation, those of us that follows the market, that it is time something was done, because we're going into a dilemma of increase in prices, low supply of goods and services, and linked to shortage of foreign exchange, and it was becoming a huge headache. So, for instance, we opened our forex space from the paradigm of pegged or managed float to a free float, with the expectation that we will have more money more foreign exchange come into the system. But because of the inflation rate, the foreign investor that we want to attract into our system would also calculate that if he brings his money, it would actually be exiting the system, on a negative note. The yield, or whatever profit is taken, compared to inflation rate, will actually be what they call real negative returns, So it will not actually optimize its investment in the Nigerian jurisdiction. So, and perhaps that was why most foreign investors held back, because of the high inflation rate we had attained. But now, with the increase in the rate, in the NPR rate, and the announced inflation targeting of the CBN to 21%, the average foreign investor will be making up his mind, will be making deductions now, that if he moves into this jurisdiction, it would mean that whatever the case may be, with the plus 7 and plus 1, minus 1 in the corridor, is likely to make an earnings, and when he's coming out, he will come out with a positive yield. That is one. Then there is also the guarantee that he will exit with his money intact. Unlike when we're doing the pegged in and all that, and you wanted to exit the jurisdiction, you could not even take the money you've made, the profit or the yield you've made in terms of forex out of the jurisdiction. There are so many considerations about it. But the basic thing is that there will be less money in circulation by this increase. Two, I will be more interested in savings now than in spending, because I will have higher earnings from my saving. I used to play in the stock market. The stock market had ramped up by, in fact, this year alone, from January to February, that moved up by more than 36%. That is, if you had invested 1 million naira in the stock market, you would have earned 360,000 naira That's how buoyant the stock market had been. But now, as an investment analyst, I may start looking at the fixed income instruments, mostly issued by governments, national treasury bills, FGM bonds and all that, because already I can see a visible increase in yield based on the declaration, the NPR rates, you know. So you see people now moving into that, creating more investment, you know, around that line. And as you do that, the expectation, especially with the 45% CRR, the CRR means that for every 100,000 deposits, for instance, in a bank, now that a bank holds, the central bank holds 45% of it. That is 45,000 of it that the banks cannot do anything with. So the banks can only do, though they have 100,000, they can only trade with 55,000. So which means there is little fund available to even create credit in the first instance.
Isn't it like clipping the wings of the banks?
It's not clipping the wings. Well, clipping the wings of the bank for the moment, so as to be able to address the headache of inflation. Inflation is a major challenge to everybody. For individuals, for every increase in inflation rate, you are actually eroding the value of whatever is in your pockets. Okay. So it is important at every point in time that the inflation rate in an economy is reduced, because it is the guarantee of you knowing the value of what you are going to buy. You can go, I think on one of these programs you had talked about buying an item for 40,000 on a particular day. The next day you bought at 70,000. Yes. You know, so it means that though your money is in your pocket, but the value of that money has reduced, okay, you know, because of inflation rates. So targeting inflation rate for me, it's very, very important. And whatever and of course, Prof is not against it. It's the approach.
He's just in the middle.
But I believe that at this point in time, if there's a need to hit it with that needle, and for once address it, let us see it, and in the next 2-3 months, it's likely we get to see the impact. One, because again, some other policies have been made, especially the removal of subsidy. So there will be no subsidy payment that would, independent of what the NPA had done, that will also now put in money again into the system that cannot be accounted for, or that had not been taken consideration of by the CBN NPR. You know, so those are I think it's important. There's that collaboration between CBN and the monetary policy, and the government over policies that will be put into the public space.
Great.
Thank you very much, Nii. You see, while it's important to target the inflation rate, because I am pro the common man.
Yes.
I think I'm one of them. And so, when you let me ask, CBN again, the director, were you doing right by the ordinary Nigerian when, in targeting inflation, you increase, you make it more difficult to borrow? What about those who do not have? What about those who need it to, do business just to survive?
Okay, so first of all, let me just say that the decisions were taken from the point of knowledge. We know that credit supply to the informal sector in Nigeria by commercial banks is about 5% of the total credit in the system. So there is that very low level of credit. And the credit system driving informal businesses is also the Asusus of the world, the microfinance banks, friends and relatives, and so on. So we have that knowledge. Secondly, we also have the knowledge of the trade-off, okay, of this decision, the impact eventually on the output. And we have observed, of course, the resilience of the recovery from the shock that was mentioned here. Now, looking at the lag structure of when these policies will manifest, going back to what Prof said about, the high rate at which, the high policy change, policy rate change. It was as a result of an extensive, simulations and looking at what happened, in other jurisdictions that delayed that decision. Turkey is a very good example. Maybe because there was election coming up and so on, and that country delayed tightening its monetary policy, and we know where, inflation is here. Was this decision in the interest of the common man? In the long run, we would say yes.
How long is the run?
Well, how long is the run? For now, monetary policy is targeting at least to have an inflation of 21.4% by end of this year. Monetary policy is going to go stepwise in providing its own target, even though we are still under an implicit inflation targeting. And I would want to also comment on the call for coordination. There has never been a good time of proper coordination between monetary and fiscal as we have today. We are not only having the PAMSEC of Finance on MPC, but there is an ongoing meetings and consultations and agreement. For instance, when the governor, the central bank says, well, we are going to exit from development financing, which in turn was creating, money supply in the system. The fiscal authority was just welcoming to that. And secondly, the ways and means that is the elephant in the room.
Which also makes the CBN a culprit, in the inflation predicament.
Yes, but of course the necessity of what started that has been explained. The economy went into recession. There was COVID, there was disruption to supply chains and so on. So every country had its central bank support the fiscal authority to be able to have the economy emerge from that kind of a disruption. So the central bank also has been very clear about complying with its own act, which gives a seal to how much government can borrow from the central bank. And by the way, this decision also targets foreign investments, because one of their desires, as mentioned, is to have real rates positive, and that is a step taken in that direction. Now, stability in the forex market would come from having alternatives for people who are holding cash in terms of investment. And that has been mentioned, that people might move from not only the equity market, but from also the FX market into the fixed income instruments. And that will create stability in the forex market. And also we will begin to see investors returning to Nigeria, which means our market, the forex market will begin to see liquidity increasing. That stabilizes. Stability in the forex market creates also stability in other things. The physical issue mentioned by Prof. Government is one of the economic agents that borrows from the banking system. So when central bank tightens further, it is also a signal that government should borrow less, and therefore there will be less of deficit. Of course, we are aware of the impact of that on growth as well. Yes.
Well, government should borrow less, you say, and
Reduce deficit.
reduce deficit. We always talk about foreign investors coming to the country and more foreign exchange coming in the country, and there seems to be a tightening of the forex market now by the CBN, and you've reeled out a lot of policies on the forex market, and some people are saying that it is killing the forex market itself. That's the black market business. And do you think that they will key into those policies you've introduced in trying to tighten the forex market?
So are we tightening the forex market? You know, the market is operating on willing buyer, willing seller. What the central bank is doing in the forex market now is to just bring sanity into that market. Okay. It doesn't determine at what rate you trade. And particularly, well, you call it black market, which means an illegal market. But for the BDCs, you would have heard that there is a complete absence of infrastructure on which BDCs operate. Okay. Most of us travel out. Currency exchange is any other business, that they should have records, they should have a trail on which taxes and so on can also be paid. That's what we experience when we travel. We want to see our BDCs, operate like that. Okay. So now recently, the central bank had to reach out to the BDCs because of the pressure, because of the limitations, the access of ordinary Nigerians to commercial banks. So if BDCs are there to meet their small FX needs, that's the direction of travel as far as the central bank is concerned. They become a channel, a recognizable channel, to meet that kind of challenge. But we are also asking Nigerians to look inwards. Okay, this high appetite for dollars and foreign goods, we should begin to look inwards in terms of so many things: education, health services, and even the dresses we wear and so on. Let's begin to look inwards and protect our currency, our commonwealth.
I was going to ask, because you have said that, okay, give or take about December, you could begin to see results, right? It could be beyond that. It is possible.
It could be beyond that. Two things come into play here. One, the lag of time for in the credit market. Secondly, the lag of time of pass-through. Also remember that inflation levels of advanced economies is still high, and we import such an inflation with all our raw materials. So they play out in our final consumer prices. But by our simulation, we think that we'll be able to reach that target of 21.4%, and even lower by end December. Now, do we need other actions before then? Of course, monetary policy is at the short end of macroeconomic policy, and that's why the MPC meets more frequently and there are frequent changes. We are very much aware that we need to closely, watch, the market. We need to ensure that the money market operates, properly, because that is where the first signal will come that this policy is working.
Now, you know why I made reference to when you think that we could begin to see the changes? if you are going to restrict the capacity of banks, of commercial banks, to support economic growth for that long, has the CBN pondered on what this could mean for the same economy that you are trying to manage?
Yes, we have. The central bank has pondered. What the liberalization in the FX market has done now lately, if you look at our GDP numbers, is that one, the industry sector that has been in, contraction over a very, very long time is now operating above waters. We have recorded positive growth in Q3 and Q4 of 2023. That's the I can say the most obvious, advantage the country has from the FX market liberalization, because that showed that businesses now have access to FX. We are not talking about the rates now, but they have access to market. Secondly, that sector is growth is also driven not only by agriculture, which is so informal in the country, but the oil sector. And the business in the oil sector is priced in dollars, not in naira. And we have seen growth in the daily production, of crude oil, and prices are likely going to remain above the 80s. The OPEC plus countries, have just taken that decision that the crude oil price has to remain. In fact, Saudi Arabia has voluntarily, agreed to cut its production by 1 million barrels per day. Come July, should prices go below that. So we are so much aware of the development, and that's the resilience we are talking about. Now, we are also so much aware of the focus of government on insecurity. We are hopeful of the gains that will come as that plays out as far as agriculture is concerned. So the central bank, through the coordination with fiscal sector, we know that this decision taken now is for a better tomorrow, while the fiscal authority works towards fixing the structural factors that particularly inhibit production, supply of food. And our inflation is essentially food driven. Yes.
Yep, indeed, and you've sort of shed a lot of light on on the decision by the MPC here, and let's bring in Professor Waleke into the conversation. I'm sure you've been listening to them talk about and the interventions, in the in the interventions in the. You are opposing. Thank
God you are sitting on the other side.
That's why he deliberately sat down there. So, let's talk about the FX forms and how it will positively impact on investor confidence going forward. He's talking about that by December we'll see a lot of changes in the might see in the monetary policy and all that, and the FX market has been reeling under a lot of shocks recently, and this decision by the MPC, how do you think it will, sort of affect, impact positively the investor confidence coming? And the CBN governor also said that it has cleared 400 million worth of verified FX backlog. So, what are we talking about here? What are we saying here?
Yes. Initially, I started by saying that I commend the efforts of the banks in the area of at least calming the market. Okay. The central bank has done a lot And the recent is this guidelines, to BDCs. I have always said, argued that the concentration initially was on the supply side, and that was why you had a situation in which government was borrowing, the CBN was borrowing, trying to get dollars to at least clear, backlogs. And even the measures to do with IMTOs, to do with net open position and the rest, we are also supply side measures. And I had argued that there should also be some attention, on the demand, because if you don't control the demand pressure and you focus only on supply, you may not have, you may not be solving the problem, sustainably. And recently they have started on the demand side. This issue of guidelines for BDCs, to me, is meant to at least reduce speculative demand for the dollar. So I think it's a step in the right direction, and I'm also hopeful that in the near future, exchange rates will really come down, and the naira will appreciate it. By the time you take out these frivolous demands, from the markets, you should expect that the equilibrium level will, settle at a much lower level than it is now. Now, I want to quickly respond to some of the, points they made, beginning with my friend Nee. Most of the time I've appeared here with, Nee on this, and most of those times we have always been in agreement. But today we are we are not in agreement today. Yeah. Nee says, and I'm sure.
That Yusuf there.
Yes, of course I am with Mother Yusuf, and I'm sure we'll continue this debate even after here. Two of us. Now, Nee had said that the basic thing here, driving inflation is, too much money chasing few goods. In other words, demand pull. We often say, theoretically, there are two types. You have demand pull, you have cost push. Okay. So, but in our own case, it's not just about demand pull, where you are saying there's too much money in circulation and therefore you want to sort it out. By the way, this too much money in circulation thing, we're here. Okay, I'm not saying it's not there. It is there. But if you also come to think of the fact that even NDIC tells us at a recent workshop I attended, they are making us understand that the bulk of what you even have in the banks today by way of deposits, okay, over 90% of that belong to just 5% of the depositors. Okay, so this liquidity you're talking about is not, circulating, it's just in the hands of
a few.
A few. Okay, but there is liquidity of it, no doubt. So that's the aspect of the demand pool, and it's only that aspect, the monetary side, that the central bank can control. But there's also largely the supply side. This fact, we must not lose sight of. There are cost push factors, and cost push factors are not within the ambit of the central bank. If you look at the National Bureau of Statistics reports, they normally report on 12 divisional items that are, driving inflation. The first one you find there in their table is food and non-alcoholic beverages. The last report they released, 29.9% inflation rate for January. Food and non-alcoholic beverages was accounting for over 15%. That's over 50% of the total. Okay? And the fact that you go to buy Mudu of Gari today, okay, just the other day I went to buy a Mudu of Gari, 1,000 naira. Okay? Something, from once in a while, I go to the market to at least have a feel. Not too long ago, it was 600 naira, 500. I'm sure, Juma, that today it is 1,000 naira.
It's 1,000.
Okay? So that is not as a result of you have too much money in circulation. That one is more of a cost push as a result of insecurity stopping people from going to farms and producing more, result of transport costs, result of energy costs. These are the things that are driving this, not necessarily too much money. So the too much money we usually find in the exchange rate pass-through, okay, and you tend to see that in the core inflation index. The core inflation index is just around 23%. The pressure is on food. So the first item you find there is food, and that's why I argue that our challenge today is more of cost push inflation and
demand
not
push.
demand pull. It's only the demand pull, the monetary factors that the central bank can control. And he will not even agree with me that even when we talk about monetary policy transmission, okay, it's not as effective as it should be in our own case, in Nigeria. So that's one. The other thing has to do with what the director also said. He said when they were doing this, they tried to benchmark countries. Okay, mentioned Turkey, and you see, we have a peculiar situation in Nigeria. Most of these countries now, inflation rate is on the decline. In the US, inflation rate is coming down. In India, inflation rate is coming down. In Ghana, South Africa, inflation rate is... So, in our own case, the trend is upwards, okay? And it's not unconnected with the twin reforms, that we had, recently, even though it's been an upward trend, even before then, okay? So, we have a peculiar case here. A friend of mine has been, saying that he's been trying to understand why, despite rising inflation in Turkey, for example, you mentioned Turkey, GDP growth in Turkey is still strong. Okay, and this is a country too that recently, if you read Turkey, they have been building reserves, including buying gold bullion, to build their reserves. It's not the same with our case here. If you look at Ghana, for example, where you can also cite Ghana. Ghana's MPR, the policy rate is at 30%. It's very high. But when you also look at their cash reserve requirement, their cash reserve requirement is just 15%. So in our own case, I said the CRR was also jacked up to 45%. So when we are looking at these issues, we should be holistic. Okay. You see, I just mentioned Turkey, rising inflation, still strong growth. In our own case, what do we have? We have stagflation. Stagflation is where you have rising inflation and weak economic growth. In 2021, economic growth came in at 3.54% GDP growth rate. In 2022, GDP fell to 3.51%. Last year, GDP fell to 2.74%. For the whole year, it was only the quarter that we are talking about 3.46. But for the whole year, it was 2.74. So GDP is on the decline. And even if you also disaggregate the sectors, the real sectors, the agri, for example, and manufacturing, that's still very weak. The agri sector only managed to grow, by just a little above 2%, 2.1%. Okay, manufacturing sector just still under 2%. So the sector that's actually driving growth, if you check the last report, financial services sector, the banking sector that grew by as much as 29%. And of course, we had improvements in the oil sector. And again, these are sectors that, if you like, they are employment unelastic. The oil industry, for example, how many people, does it employ? The same goes with the financial services sector. It is the agri sector and the manufacturing sectors where you find the jobs. And that is why you need to help to incentivize these sectors. You see, Victor, when we say economic policy has one goal, and that goal is the welfare of the people. And that's why you find, even in the Constitution says security and welfare. Now, how do you achieve welfare of the people? Okay, you do that using macroeconomic goals. What are the macroeconomic goals? You want to achieve low and stable inflation. Okay, the responsibility of the central bank. You want to achieve, growth, sustainable growth, inclusive growth. You also want to achieve low unemployment rate. These are the key ones. I know you also have balance of payments and income distribution, but the major ones is low and stable inflation, growth, and unemployment. Macroeconomic goals. Why do you need them? They need to work together to achieve welfare. Is that not so? Now, the Ministry of Finance is responsible for executing fiscal policy. Okay? The central bank, primarily for monetary, policy. And, talking about collaboration, the two must work together. So, if the central bank is implementing its policy of low and stable inflation, it should have an eye on growth, even though its focus is on monetary policy. If the Ministry of Finance is also implementing policies meant to achieve growth and low unemployment, it should also have an eye on inflation. Okay? So the Ministry of Finance will not say now because, or the government will not say, fiscal side will not say because ours is just growth and unemployment. Let's just focus. Let's forget about unemployment. So what you know what that will mean? The Ministry of Finance will just be, the government will just be spending. Okay, you know where I'm coming?
Yeah, I know.
Then jeopardizing monetary policy. Monetary policy will not say because our own is just inflation. Because for me, that is what has happened. In the MPC just focused on our own is just inflation. Let's not bother about what happens to
the micro. Yes, about
they need to work together. You see, government of the day today, government is talking about consumer credit, talking about how to reflate the economy, talking about how to get people have access to credit. That is what the present regime is talking about. So the central bank should support that. When the government is saying consumer credit, student loan, on the one hand, central bank is jacking up interest. So that will
more difficult.
That's not synergy. So I think the two should work together. The Taiwan Oyele committee is doing a very good job. Very good job to see that taxes are streamlined. The business environment is created. Businesses even grow, make profit to be able to pay tax. Okay. And then on the other hand, we'll have an institution that's trying to squeeze that. So
squeeze the nose around the neck of
the
creditors.
two really should work together.
Okay.
Tightening is okay. That's my position. But as I said, it should be done with an eye on the other, economic.
All right. Thank you very much, Professor Uche Wadeke. It's getting interesting. We'll get to the business end of it when we return from this break. Please stay with us.
You're welcome back, and our guests are still seated in the studio. We're having conversation during the break, and we've had varying opinions on the MPC decisions, and Dr. Tumala has been saying that maybe some of the varying opinions is not really looking deep into the decisions taken by the MPC about the 400 points. And do you think there will be a review of the policy in the nearest future? Is it going up, or are we going to look at it coming down?
So if MPC has decided, or the framework to use for monetary policy decision, it's very clear. Each framework has a way, attributes minimal things, and market knows what to expect from MPC. So the stance of MPC will depend on where inflation is at any given moment with respect to the target where it wants to reach, and so that will guide MPC. Now, I just wanted to comment on Prof's the loose coordination between fiscal and monetary. The target for inflation this year was not. It was predetermined, as part of the budgetary process for the year. So there is that agreement and harmony of policy between the central bank and the fiscal policy. Now the discussions around the table is what will each party, each side do, to reach, that target. And by the way, we have even a bigger target. The president wants this economy to become a $1 trillion economy. And we see that with high inflation, you cannot have a sustainable growth because businesses cannot plan, investments will not come in, and therefore that compromises, that objective, which is a realizable objective for the economy. But you see, economists have two hands, I think, and their responsibility, as Prof mentioned, is to hold a tripod like that camera, and their two hands are limited to only carrying just two. One must be lit, and he realizes that there will be limitations as far as monetary policy is concerned. Now, it's a good information to share, or shared by Prof, that only 5%, hold the liquidity surplus that we have in the economy. So what do they put that liquidity to? We see them in the FX market. We see them at farm gate taking up, products, during harvest. So we have artificial, scarcity before hoarding. Of course, we are very much aware of what is happening at our borders. The vice president and the president making statements about, different, states are taking different measures to ensure that, trucks don't move. So this decision will provide, as stated earlier, that fixed, income instruments will become available to those who have cash. Treasury bill was as low as 4%, but because of the reforms the central bank did at the end of last year around the money market, treasury bills went as far as 18%. And we have seen immediately, pressures dropping, on the FS market. So we are looking at it holistically with the fiscal authority, not in isolation. I think the bank just needs to do what it needs to do before inflation gets out of control.
All right, thank you very much, Dr. Tubala. I like the way you try to emphasize that you are not MPC, even though the difference is that one is committee and the other is department, but they share the same monetary policy in the two others. But let me get back to Lee. You tend to agree with the decisions of the Monetary Policy Committee. But the question that many have asked is why now, given the situation of things, as it concerns the capacity to buy, the capacity to even eat, and the rest of them. Why now? It's looking like too much at the same time.
Well, I think for managers of economies, the important thing is to determine at a point in time what needs to be done. I want to believe that the CBN has access to appropriate data, and that these decisions were made based on data available. As individuals, we may not have access to such, so I want to give the CBN the benefit of doubt. And then when you also look at the direction, the mandate direction of the CBN, you will see a movement away from what we used to have. We've had a period of challenges for which a number of policies were applied. Now that policies have become a situation for us, and we needed to extract ourselves from that situation, and this is being applied. And I think this is the appropriate way to go about it. Talking about demand pool and cost pool, I don't usually stratify the factors, into different cadre. Demand pool inflation may be as a result of cost pool inflation. Cost pool inflation may be as a result of demand pool inflation. If you have so much money to do with, it will have a way of resonating on the other aspects, of the economy. The important thing is you have inflation as a challenge, and what's the appropriate way to attend to this challenge? Yes, there's a monetary policy approach to it. There's also the structural approach to it. For instance, we are talking about security around the food supply area. It is not just security alone. You also have access to markets. You have so much volume of food, blocked off into the farm gate because of access to markets, bad roads. There are so many farms that cannot be accessed by trucks. So those are aspects that needs to be considered. But the truth of the matter is, fundamentally, you have an issue with MPR as related to liquidity. And once you know that is a challenge, there is a way to also, you have a manual of attending to that. And I think that is what the CBN is doing. And of course, you also have opportunistic factors too. That comes with the Binance the CBN talked about, you know. For me, it's a revelation to say, and at the point in time, I mean, the last time we discussed Forex here, I said from my private investigations, a number of Nigerians were betting on the Naira-dollar pair, and were betting on Nigeria, on the Naira, falling consistently. You know, those were intelligence we were gathering at that time. But the CBN had put a face to it, and it's not Binance alone. But to say that a particular crypto trading platform, you had $26 billion. That is $26 billion worth of Naira, you know, passing through. It does mean that those 5%, you know, owners of businesses, I mean, of accounts, deposits in Nigeria, found a way, you know, of traversing and channeling that kind of money. When you channel that kind of money into the FX market, it would, the Naira would depreciate. Yes. You know, so I think we should commend the CBN to by even, you know, recognizing and discovering that kind of, and I know it's not Binance alone, because I am active, a little bit active in that segment. And I think there should be further way of discovering this kind of manipulations. You know, it's normal. It's when there's a tendency of value depreciation around currency around the world, you see operators, fraud operators in that segment that will come and, of course, sit on that currency because it has become vulnerable as far as they are concerned. And there will be no news when you see consistent depreciation. So going forward, I appreciate the fact that the revolution made, it's a revolution to me, that MPC now has a sitting member of the fiscal authority as part of it. That shows collaboration, and it's important that it reflects in the outcome of policies that we are seeing. And then, perhaps more importantly, is the time lag. We know that there's always a lag between application and deployment of policies and the reflection of that policy. One way or the other, I feel sanguine, you know, because when the courage with which the CBN had come out, you know, it's about courage, had come out to apply this medicine, as it were, I think should be commended.
No matter how bitter.
Because it's not about being bitter. We have experienced a continuous process of sweet bitterness in the Nigerian economic sphere. So why don't we determine what we want? Is it bitter or sweet? And I think at the point in time, history itself, circumstances itself, denotes that a generation must sacrifice certain things, you know, to be able to achieve, you know, certain things going forward, even for the generation that are coming behind, you know. For instance, I do not see it as a thing worthy of celebration when Nigerians determine that their children must school abroad. And for instance, the figures we have over between 2010 and 2020, we spent $40 billion of our scarce FX resources on education abroad, on tourism, medical tourism abroad. And now we are also now seeing reverse traffic from people coming from developed countries to attend our hospitals. Yes. And we have also seen reverse too, where our educated graduates from Nigerian universities are in hot demand. They were not trained in Sussex. No. They were not trained in Oxford. They were trained in the universities around there, and they have become hot items in the jobs market across the world. So why would I want to now spend so much of this cash forex to sponsor children that have access to this same form of quality education here? And it's, of course, the more you do that, you are, of course, depleting the little forex. And I talk about equity in forex. The forex reserve belongs to all Nigerians. So it cannot be the area of interest or influence of this small number of people that have access to money that can access a forex. So if you are going to access the national commonwealth as it is, there must be a good fundamental and productive reason for you to access it.
Indeed, you've raised a lot of issues, but as always, our time is running out, and some might even argue that, well, they would like their children to go to school in Nigeria, but unfortunately, the strike actions continues to frighten them. That's why maybe they take their children abroad to school. Let's bring him, Professor Uche, into the conversation now, and let's talk about the areas of the economy that the monetary and fiscal authorities need to prioritize to strengthen the naira. And I'm giving you just 1 minute because we're almost out.
I'm just saying that, let me quickly say, you see, yes, inflation is rising, but we shouldn't be obsessed about the number. Okay, one way this inflation number can even be crashed. Yes. If you want to crash it to 15% today, or even central bank has a target of within 6 and 9%. If you want to crash it today, all you need to do is, on the fiscal side, for example, the government will, raise taxes. Okay, if you raise taxes of income, say companies' income tax today, you jack it up to 40%. You raise for states, you also raise the personal income tax, and so on. You reduce disposable income. Okay, if you reduce the disposable income, and on the part of the government, they reduce spending. If you go back to the aggregate demand equation, C plus I plus G, you target all of that and reduce. Aggregate demand drops. Central bank is also doing what it's doing, and then the number crashes. What have you achieved? What have you achieved by crashing the number and then, pushing the economy into recession? So it's not just about the crashing. That's why I said, whatever central bank is doing, you should also have an eye on on the output. You see, if you are sick and you're supposed to take medication, 3 pills a day, 1 in the morning, 1 in the afternoon, 1 in the night, to be well, okay? You don't, because you want to be well, take the 3 of them at the same time. So that's what central bank has done.
We have just a matter of seconds now. But I'll just allow Dr. Tumala to give us his closing thoughts, and I'll be asking what the CBN expects of Nigerians. How do you expect them to conduct themselves, their financial transactions, their economic transactions at a time like this? Of course, taking into account what the situation of things are and the decisions of the MPC.
Well, the CBN expects Nigerians to begin to realize the key objective of the central bank. Why central bank is there is to ensure price stability. It may have done things that may have contradicted that responsibility in the past. That has come to an end now, and this central bank is going to focus on price stability as a way of ensuring that lives get better.
All right.
I pray life will get better, for Nigerians with this. Right. Like you said, Ghana has been pushing it, and ours came a little bit too late. So, Doctor, yes, Mohammed,
Monetary Policy Department, Central Bank of Nigeria. Thank you very much for the insights and for your time.
Thank you very much.
We also thank Professor Uche Owaleke, President, Association of Capital Market Academics of Nigeria. Thank you very much for joining us.
Thank you, Victor.
And not forgetting our own Niya Kinshiju, investment and financial analyst.
As also Chairman, Independent Media and Policy Initiative, Investment and Financial Analyst.
So
as always, it's a pleasure to have all of you here to talk about this issue. And I'm sure, just like me, a lot of Nigerians have learned a lot about the decisions taken by the MPC and how it can impact the Nigerian economy. Thank you so much for coming. And that's Good Morning Nigeria for today. I am Juma Yusuf.
And I'm Victor. So we appreciate your company. Do join us again tomorrow for another episode of the program. Enjoy the rest of your day.